What is the great melt up? This term describes a scenario essentially where assets start to skyrocket, prices go through the roof. This really kind of is fueled by monetary policy that's not under control. This is causing a lot of inflation. This is caused by a lot of debt building and snowballing. And between those two things, prices, markets, everything explodes upwards. So here's the situation we're in today to understand. Debt is growing at a completely unsustainable pace. Borrowing costs are becoming much more difficult for us as a country to manage. And the most likely scenario, the most likely fix that we have is that the government, the US government, is likely just to resort to printing more money. The biggest thing that you're seeing in the news today, especially in the financial markets, what are y'all seeing out there? That's the big question. I'll tell you mine. I'll kick off the financial news that I'm scratching my head at a few things today. The first thing is going to be rate cuts. That's good, right? We got a 1/4 point reduction. Pretty exciting to see the Fed sticking to what they said and what they were likely to do. The difference is now what happens over the next year. So we've covered it in a number of webinars, but the dot plot, the Federal Reserve dot plot, that typically gives us an indication of where the Federal Reserve, the board, the Federal Open Market Committee sees rates going over the next 12, 24 plus months. That all shifted today. You might have noticed the sea of red in the stock market that we all saw. I think the S&P was down, what, 3%? Can anyone spot check? I think it was about 3% down, S&P alone. So what that was, and a big chunk of that was the Federal Reserve adjusting its expectation over the next year to not reducing rates as much as they had indicated previously. So that is not as optimistic for many, one being businesses, stock market, they like the low rates. That's always good. It keeps optimism high. But two is it has people wondering what's going on in the market. That has the Federal Reserve a little spooked. So we definitely have our eyes on that. We definitely stay close to what the Fed's putting out and making sure that we see what they're indicating. I think since the Fed got a little egg on their face previously, remember the old Janet Yellen, inflation is transitory. To their credit, I will give them credit. I think they've been a little more transparent, which is much needed. So today we are talking about a very exciting topic. We're talking about the great melt up. A lot to get through today. It's very data dense. We're going to show you a lot of great charts, but also some good announcements today, some ways that we can give you guys back some cool things that we'll get into in just a second. But first, here's an overview. We want to make sure we're organized and letting you guys know how this lays out for today. First, it's going to be, we'll go over the debt crisis at hand, really the driver of what we're talking about here. Then, once we've laid the foundation of what we're dealing with, we'll go over 4 potential solutions to this debt crisis. Next, we'll go over why inflation is here to stay. Now that we've analyzed what we can be done about the debt crisis, why does that fuel inflation over a long term? I wonder what that might do to interest rates over a longer period of time. And then last, and most important, in my opinion, is how to position your portfolio for the inevitable outcomes that we'll outline here. We like to kind of put together an economic analysis and then an investment analysis at the same time, because it's not just about what we cover or what's going on in the economy. Most importantly, and why we try to give back and do something a little bit different on our webinars, is what you can do about it in your portfolio, how to live a better life, more financially sound, and more rock solid. So before we get too far, a little bit about me as the host to get you some info. My name is Nick D'Angelo. I'm president at Saint Investment Group. Thank you for joining us on behalf of me and the Saint team. If we don't know each other personally, then I want to, tell you a little bit about myself. I get the honor of being kind of like a thought leader in the real estate and investment world. I do lean heavily into economics because I really, truly think economics is the driver behind all of the investment world that we talk about. So, specifically, what we're doing in the investment world today, we have an income fund outlined here. You'll see a lot of the stats there. Over 500 mortgages in the fund in over 21 states and growing. Total assets under management over 206 million. At the high end, we pay up to 14.28% return. We have never missed a distribution to investors, and that has been over a decade. So those are two separate things. We've been doing this for over a decade. We've never missed a distribution to our investors. We've been on time every time. So very exciting. This is just one of my favorite slides. Pretty self-explanatory, but a lot of the things we already went through. 126 months, over 126 months of on-time distributions consecutively, 206 million in assets under management. This number I love. That's a lot of hard work. Our team is hard at work on the asset management side, and they've produced pretty shocking returns on over 8 successful exits, north of 35%. And we've distributed over 13 million to our amazing investors. Okay. We get asked this all the time. Just who invests with you? What do they look like? What do they like? What do they have to say? We ended up just putting together an entire page on our site about testimonials and reviews. Also, I encourage you to Google us. Between all of these, it should give you a good idea of who we are. We're pretty proud of our investment community. And there's a few names right here. Richard Fong, Clint Lawrence, Billy Kim, great individuals, business owners, just really stand-up people. I encourage you to check out our site and check out what people are saying. We try to compile some good ones there so that you get an idea of our community. And then this is an interesting thought that I want to leave you with. As we go through things throughout this presentation, the question is, just like we outlined, is what do you do about it? Okay. There will be changes in the future. We're seeing them right now. The Federal Reserve is indicating they are departing from their aggressive rate cutting strategy. They have a much more calm rate cutting strategy in 2025 that they're telling us ahead of time. And my gut tells me even they'll peel off a little bit more from that. So the question is, what do you do with your money? It's always the question on these webinars is, what do you do with your money in the midst of everything we're talking about? We have an option for up to 14.28% returns. We think that's pretty great. I think fixed income is worth looking into. I would have that in the back of your mind as we go through this presentation. Quick outline of what this looks like. We'll jump into a legal disclaimer. We'll keep our attorneys happy. Then we're going to jump into the topic. Then we're going to wrap up with a couple minutes of just housekeeping and rounding off a couple items. And lastly, but definitely not least, we will have open live Q&A. So this has been building the last handful of webinars, it's been extremely valuable, amazing conversation. And it's time for me and our investors to get some FaceTime together, for our team to understand your thoughts, what your concerns are in the market, to understand what your biggest questions are. So it's our time to really just round up and have some discussions together. It's extremely powerful, and we have a gift for you at the end. So I highly encourage you sticking around through our Q&A. All right, quick legal slide to keep our team happy. There's really 3 main things on the slide. I encourage you to read this, but there's 3 main points. 1, this is not investment advice. Number 2, this is for educational purposes only. Candidly, we started doing these webinars because we're already doing the heavy lifting on a lot of these topics. We're digging into these topics, and we just wanted to give back to our investment community. What we found is selfish. I'm going to be honest. We found that the more educated our investors are, the more likely they are to invest because they understand our product better, they understand what we're doing, and they know that we're covering the bases of what's going on in the economy. So absolutely, we want you to be educated as much as possible and give you as much info. It does benefit us, but most importantly, it benefits you. And then last, this is a good note. All investments carry risk. Past performance does not ensure future results, but it might be a good place to look to understand the track record of a team and an investment group. Okay, this is what I was excited about. This is our giveaway today. So, guys, this is a book called The Banker's Code. And our team, we have a brilliant team that has really high level discussions regularly. And we compare books, we compare notes, we compare economics regularly, like really at a really high level. What this book does and why this book's special and it's chosen for our giveaway this month is because it breaks down basically how banks and private investors in debt look at high level their portfolios. So this is them looking at the market, how they personally invest in debt, how they think about it. And, kind of the old joke is banking is the second oldest industry in the world. We won't go into the first, the oldest industry in the world, but there's a lot of wisdom here because of that. So there's a lot of strategies. This book outlines a lot of what we think at Saint about debt and the benefits of it, how you cover your risk, how you analyze investments. So I can't say enough good things about it. And it's well written, it's easily approachable. It's not overbearing or really difficult to read. So there's two ways to get this information. One, we just started including the codes so that you can take a picture with your phone and you can just go to the link and buy the book yourself. Or more interestingly, we can send you a copy of this book. We will be sending you a copy of this book for the best contributors, people that are asking the most questions, you're answering the polls, you're commenting on things along the way. And if you are contributing and you're very engaged, the best contributors, the best engagement, we'll be sending a copy of this book. Last time, I think we sent out a handful, actually. We just had a great conversation with a really good crowd. So definitely drop questions, comments in the chat. That's the best way for us all to be connecting, and take the polls, and we'll get you a copy of this book if you really are adding a lot of value in doing it. So let's frame the discussion here. What is the great melt up? This term describes a scenario essentially where assets start to skyrocket, prices go through the roof. This really kind of is fueled by monetary policy that's not under control. This is causing a lot of inflation. This is caused by a lot of debt building and snowballing. And between those two things, prices, markets, everything explodes upwards. So here's the situation we're in today to understand. Debt is growing at a completely unsustainable pace. Borrowing costs are becoming much more difficult for us as a country to manage. And the most likely scenario, the most likely fix that we have is that the government, the US government, is likely just to resort to printing more money. And while we here, again, we have a high level community that's pretty amazing and high level as far as thinking about the future and investments, it might be controversial for us to think about the government just printing their way out of another problem. But historically, especially lately, that's been the solution. That's been what we've seen. So inflation as a challenge, we all know the challenges of inflation, rising costs of living, higher rates that we all experience on a regular basis. Inflation can also actually provide a huge lift to asset classes, to many asset classes. So if used appropriately, and if you're investing in the same flow of inflation, in the positive direction of inflation with the right assets, you can actually see a lot of benefits from inflation along the way, even if the symptoms are painful and there's some things in the market that won't benefit. To understand the genesis of a lot of these problems, to understand the beginning of a lot of these, we can look no further than 2008, the global financial crisis. Many of the things that we'll go over today started during that period. So as a quick overview, debt is growing exponentially. The US debt is growing exponentially. The genesis of much of this is the global financial crisis in 2008. Borrowing costs on the debt that we already have is completely unsustainable and growing. The most likely scenario is for the government to print more money. And what are we going to do? What are you going to do about the inflation that all of this causes on the back end? So let's jump in and take a look at the numbers behind the phenomenon that we're talking about. As of now, as of this second, the US national debt has reached over $36 trillion. So this 35 right here, actually 36 trillion as of today. This is July 2024. To put this into perspective, that's approximately $104,000 per US citizen, per person in the United States. What's even more alarming about these figures is that since 2020 alone, so you can see in this chart, since 2020 alone, the US has added over 11.8 trillion, so just the last handful of years, to its debt. Over 1/3 of the total outstanding debt has been in the last handful of years. Since 2008, we will see the issue started to snowball. Again, we can kind of point to it in the chart here. And you guys can see my cursor, right? I like to highlight stuff.
Yes, we can see your cursor.
Perfect. So you can see the acceleration. We can see, a steady trend, still not great, but 2008, boom, we start to take off. Boom, 2020, boom, here we are today. This is an important chart to understand really the unsustainability of what we're talking about. This chart that we're looking at shows the federal debt all the way back to 1794 and the projected debt all the way through 2054. So essentially towards the beginning of our country, all the way through 30 years past today. So as we move forward, it's critical that we're understanding and recognizing that the federal debt is on a path that's unsustainable. One of the main reasons for this is the rising cost of servicing the debt, and we'll break that down in a second, and the interest payments associated with that. The obligations that we have as a country on this interest are just snowballing out of control. There's spikes along the way, right? It's not just that we have shortfalls in a couple small places. What we're seeing are spikes for wars, right? Great Depression, also major economic moments in history, major wars, major conflict. What you'll see typically is the debt declining. Why is that? Because historically, what we did was if we entered a situation where we needed to raise money by taking on debt, we raised taxes. That's how you balance a budget, right? So World War II, wow, huge spike, but we raised taxes all the way up to huge numbers that are unsustainable, but we raised taxes to pay down our debt. The difference is what we started to see right around this neck of the woods, the Bush wars, the Obama wars, we actually saw tax reductions across the board in many categories. So the wars that we were taking on debt to pay for weren't getting paid for from tax dollars. It was all going on the debt side of the balance sheet. Also, I'll note this is from the Congressional Budget Office. Okay. So, I mean, we're talking reputable sources giving directly this information. This is not third party. So it's about as accurate as it gets as far as it relates to understanding this data for almost the entirety of our country. Okay. The federal debt, the total public debt that we're looking at. Let's zoom in and take a little bit of a closer look for just the last handful of decades. Okay. This chart is from 1970 through today. What we see is just pretty low debt overall and then snowballing. The gray shades, you can see recessionary pressures. Recession, you can see COVID here, you can see 2008, the global financial crisis. What's interesting to note about this chart is what happened in 1970. We got off the gold standard. Okay. So that is an interesting note that once we got off the gold standard, things still really got off the rails and kind of got exponentially in the growth phase. Then the GFC 2008, the government implemented significant fiscal stimulus, aka quantitative easing. These initiatives essentially they were aimed to stabilize the economy, and we needed it. We needed it. We very much needed it. It was a really tough time. It was a market crash. So we needed to bolster the economy. But the issue was that it wasn't managed on the back end the way that we could have done it. So by 2019, we see here, debt nearly tripled from 2008 levels. or excuse me, 2008 to 2019, right? Debt nearly tripled. So we see that around 8 all the way to the $24 trillion mark. What it reached in 2019 is an interesting point because that point hit a number of 79%, our debt, of our GDP. The ratio that is called the debt to GDP ratio, and it's essentially a spot check on a country, a nation's economic health. So 79%, shocking in its own right. Now, granted, many other countries have it much worse. They're in a much worse place. I believe Japan's north of 300 debt to GDP ratio. China, I think, states like 70, 80% debt to GDP. If you run the numbers, they're around 240% debt to GDP ratio. But kind of a digression, just an interesting note. Debt to GDP ratio, a good metric to have in mind. In 2019, we are at 79% debt to GDP. With the onset of COVID, we obviously saw massive government spending. We saw massive stimulus. We saw unemployment benefits expand. We saw business assistance. We saw the stimmy checks, right? The stimulus checks that everybody got in the mail. The government also forced an entire economic shutdown. So while we were setting precedents for massive spending, we also were receiving less from tax revenues because it's hard to make money when the government has shut the entire country down. So these measures, all these combined, resulted in pretty massive, sharp increases in national debt, which was 26 trillion by mid 2020. Now, lots of debt, huh? The question is, what about the interest on that? How much does this debt actually cost us? So let's dive deeper into this and understand the interest rates and the impact between these and how we all end up with a bigger bill to pay as this debt snowballs. So this chart covers 2010 to 2024. Between 2010 and 2024, the government experienced a massive increase in the interest costs associated with this debt. Why is that? Well, simply put, the government debt tripled. Okay. So if the amount that we owe tripled, the interest expense on that debt also went off the charts, which we can see, right? We can see that huge upswing. From in 2010, the government paid approximately 414 billion in interest on our national debt. Over the next decade, so if you speed up 2020, over the next decade, despite having pretty low interest rates, I think we all remember like the 2-3% and all of us being like, this is insane. These interest rates are nuts. How can they possibly do this? Despite low interest rates during this period of time, by 2019, our interest payments were almost $575 billion. So pretty staggering increase. They continue to climb, and by 2023, we were paying 678 billion in 2023. So huge increase of just how much we're paying on the interest expense of the debt. Okay. Here's the last point on this. In 2024, gross interest payments on the US debt surpassed 1 trillion. This is a massive milestone and not in the good way. Okay. This is the first time that we've ever crossed the $1 trillion mark on the cost of our interest on our debt. And from there, we also exceeded just our interest, just the debt interest is now exceeding Medicare and defense spending. I want to hammer that home. So what does this mean? This means the interest on our bad budgeting is now costing us more than services that actually help American people. That's the note. That, and I say this all the time. I say this anytime I'm asked about politics. I'm an economic voter. I vote based on economics. Whoever I think is going to be best for the economy of the country. Why? Because if you have a balanced budget, if you make the right financial decisions for the country, it benefits people overall. Right now, what we're seeing is $1 trillion just in the last 12 months was spent on things that don't even benefit the citizens. So just a thought to leave you with when we think about politics and how that's the backdrop for a lot of these debt decisions. So, a weird situation. Why is the Fed cutting interest rates? I mean, we see that inflation's actually ticking up a little bit, not fully tamed by, actually not by a long shot. The reason they're cutting interest rates is because they have to in order to afford the growing interest payments on the government debt that we just saw. In this chart that we're looking at here, we're seeing the net interest cost through 2034. We're seeing that projection. So we can see that the interest cost it's sharply rising over time. So this is a major concern for the government, for the Federal Reserve. So in order to quell this, in order to slow this down, it's cheaper for them on their interest expense to lower interest rates. The problem here is that this is a temporary fix at best. This is not sustainable. We know this to be certain. So it's crucial to understand that while lowering these rates can provide the short-term relief that they're going for, it doesn't actually fix the underlying issue or the growing debt. I love this illustration. This is a comparison here. This is a breakdown of the debt from a few different angles. So in the last year alone, the federal debt has risen over 2.3 trillion right here. Okay. As a result, the interest expense on our debt rose a whopping 28%. That's the 1.1 trillion that we talked about. So this just kind of illustrates how unsustainable this really is. Now, it's important to see how much we make. So our tax receipts, the number one income for the government, tax receipts, and then how much our interest is costing us in relation to our taxes. This chart basically compares how much tax receipt overall income that we have, which is the red line, versus the government interest payments on debt, which is the blue line. The ratio of interest payments right here as a percentage of tax receipts has risen to over 36%. So every dollar that we bring in, over 36 cents of that dollar immediately is allocated to interest payments. Painful, painful, painful. So, why is debt rising? We've looked at the government debt. We've looked at the interest on the government debt. Now let's shift gears a little bit and explore government income and the government expenses so that we can understand specifically if there's any way that we can reduce this or improve this situation just by looking at the balance sheet. First things first, let's break down the income, the total revenue of the US government of 4.92 trillion. So as of 2024, we have 4.92 as the total revenue. This is a general breakdown. You can kind of see the size and how much we receive from each category. Individual income taxes, 51%. Social Security and Medicare, 37%. Total revenue of 4.92 trillion. How could we possibly blow through all that money and more? Well, this is the top 10 ways that we spend in the United States. Number one, at 1.35 trillion per year, we have Social Security. It's the largest expense we have as a country, and that makes up 37% of the total budget. We have national defense at 18%. We have different healthcare, Medicaid, CDC, NIH, but not Medicare, just as one note. As number three, our net interest is the fourth, over 1.1 trillion of the 5 trillion total budget that we have. You can see some of the others just kind of broken down. So, I mean, we're looking at the list here, right? We see exactly what the government has allocated and what the spending looks like and what the income looks like. Where could we cut $2 trillion? Which of these categories? Is it Social Security? A lot of people are not going to be happy about that, and they vote. What about national defense? Should we be cutting national defense when there's wars going on globally all over the place? What about healthcare, Medicare, right? The pickings are slim in this list. It's probably pretty difficult to figure out which would be least impacted and which wouldn't rock the economy to its core. So this chart is so powerful and so simple. We make 4.92. We spend 6.75 trillion as a country. for a grand total shortfall of 1.83 trillion in deficit and growing and growing. So, what does this look at like long term? Sure, we know what this last year was. We know what recent years looked like. What is the outlook projected over a long term basis? Well, let's take a look. We see the projected spending and revenues through 2054, so the next 30 years, from the Congressional Budget Office, so a reputable source. We see they're only getting worse. Spending going up, revenue's pretty linear. Revenue's pretty linear. We kind of see that it just has the same trajectory. Over time, the gap is only growing. Lowering interest rates might help, but it will only buy us a short period of time. So let's recap real quick before we jump into the next section here. US debt is surging. The US debt to GDP ratio today, we talked about 79% just a few years ago. Today, the US debt to GDP ratio is unfortunately over 130%. We are dealing with an unsustainable borrowing cost snowball, which is driven by the government spending more than it makes. Simply put, the raising interest rates are only fueling this more, and lowering interest rates is a likely outcome. It will buy us more time, but it doesn't solve the problem really at all. So, excuse me. So, there are some solutions. There are some potential solutions here. There are four main ones we identified. There's all kinds of wacky ones out there that are just unlikely. These are the top four. Number one, the government can significantly reduce the deficit by making more money, boosting tax revenue, increasing taxes is what we're talking about here. Now, we'll talk a little bit about Hauser's law shortly, which probably appears to be the upper limit of what percentage of GDP the government can actually tax before it starts pulling the economy downward and reducing the economy and GDP overall. So Hauser's law, keep that in mind. Number two, the government can balance the budget by reducing expenses. They can spend less. Could they, though? I don't know. We'll dig in. Number three, we could just default on debt. This debt is crazy. It's way too much for us to manage. We're talking $1 trillion a year that if we just stopped paying it, it might help balance the budget. Maybe not. Maybe the outcomes of that would be worse than the debt that we're incurring, but we'll dive in there. And option number four, we can just print more money. We can deflate the currency. We can debase the currency more. And then the dollars that we pay back on that debt are actually less valuable. And then we can just kind of grow the economy through kind of like steroids, right? Printing massive amounts of money. Huh, that's interesting. I wonder what notes we have there. So, option one, let's start breaking these down a little bit. Let's start by talking about increasing taxes to boost the revenues, to boost the income of the government. Okay, how could we actually literally do this? What this would look like would be an across-the-board increase of taxes by over 39% in all categories: individual, payroll, excise, business, etc. Could you imagine what would happen if they increased taxes on every citizen by 39%? Just I'll leave you with that. You can think that through. It wouldn't be good. It wouldn't be good for the politician's career. Let's put it that way. There are other tax levers. There are some things, there are some solutions that could chip away at this. We could return income tax levels to year 2000 levels. We could raise the Social Security earnings ceiling so that 90% of earnings are taxable. We could repeal the 2003 capital gains, et cetera, et cetera. There's all kinds of options here. But we talked about Hauser's law. Hauser's law states, and we will see consistently over economies, consistently over countries, the upper limit of how much you can tax a citizenry, population, equals typically on average about 19.5% of that country's GDP. That's what we see as the upper limit. If you go beyond that, what actually happens is the economy, there's less money in circulation, more money is being taken out by the government, and that actually tanks the economy. It drags it back down. So there does appear to be a very real upper limit of tax percentage of GDP. So any of the things we covered, most likely it's going to max out at 19.5% of GDP. There appears to be a ceiling. So let's look at option number two. Let's quit spending so much. Let's cut spending to balance the budget. Is this feasible? Okay. Last time we said we need to raise taxes by 39%. It's similar. It's similarly painful. In this case, we would need to cut spending by 40% across the board. Okay. That would include Social Security. That would include our military, Medicare. I mean, we're talking across the board, everything. Okay. So is that feasible? It's really not. It's really not. Not just because it's probably near impossible, but because the people that are getting their government benefits from the people that are receiving government benefits, they're not accepting 40% less of any service. Okay. So they also vote, remember, they vote and they would be brooming whichever politician most likely that would be pushing this. But here are some things we could look at. Cutting these programs, cutting Social Security, it's most likely political suicide. But there are some other options. There are some other options. Some things that have been approached that might be feasible. One is the fact that the US government is the largest employer in the United States. The US government has over 20 million jobs. That represents a massive piece of the economy. There is a possibility here of cutting jobs by, some estimates are up to 10%. This would pretty meaningfully reduce the deficit and would also, on the other side of the same token, create 2 million jobs, or would add 2 million unemployed to the market. So while we would reduce government spending by, a huge amount, the reality is that would increase unemployment by 2 million jobs. It would be a massive issue. How could this work? We'll just think it all the way through. So DOGE, the Department of Government Efficiency, is coming online. We covered this a lot in our last webinar. There's all kinds of discussions of what Trump plans and what he's discussed and what he's trying to implement here. But this is one route that has been talked about for DOGE to take. Because the number one thing here is that even if it does create 2 million jobs that are now unemployed, 2 million individuals that are now unemployed, a brutal situation and a huge spike in unemployment and likely causing, a huge crisis in the US, the reality is the fundamentals of economics say government cannot actually boost GDP meaningfully. If the government hires more people, that's not a boost to GDP, right? At best, it's a break even because the government taxes on one side and then hires on the other and then applies those tax dollars to those people's income, to those people's salaries and bonuses and all that. That's not an add to the economy. At best, it's a break even. At worst, there's huge government inefficiencies. It's actually a drag on the economy. So the thought process goes, let's say you cut government jobs by 10%, 2 million people, a brutal hit to those people, to all 2 million, and to the economy. But the thought process is if you could move those 2 million jobs to the private sector, now we might have an opportunity to actually meaningfully both reduce the expenses, reduce the budget, and increase GDP. Because if you move from the public sector to the private sector, the government sector to the private sector can boost GDP. If those people are in privately owned companies or doing things that bring, a benefit to the US economy, they actually can boost the economy in that way, boost the GDP in that way. So it is possible, and it's an interesting thought. Is it real? Does it have any reality to it? The reality is it's extremely unlikely. The game plan to do this would take years to navigate. It'd be extremely complex, tons of assumptions built in there. And the reality is we'd probably end up in a recession or a crisis. Okay. So is it unlikely to occur? Yes. Most politicians wouldn't even think about tackling this, but it is one scenario that could reduce spending by the government and boost GDP at the same time. Okay, option number three. Let's just stiff everybody on our debt. Let's just default on our debt obligations. What would that look like? Well, this one potentially could be the worst option. We outlined what could happen, a number of things here, but it would be crippling to say the least. It's one of the few scenarios that we just talked about, or really that are on the table at all, that could lose the reserve currency status of the US dollar. If we lost the reserve currency status, we would lose our number one competitive advantage as a country. Economists know this, the government knows this, politicians know this, and even other countries know this. So it's just a non option. We are not defaulting on this debt. I would bet my bottom dollar on that. The implications would be too drastic. So, not only that, I mean, just the US, this is basically a recap that the dollar is very fragile. There are calls to de-dollarize globally, right? Other countries are increasingly trying to use alternative currencies. You even have BRICS, right? Brazil, Russia, India, China, South Africa, and a number of other countries that are now kind of dogpiling in there, talking about things like BRICS Pay, an alternative currency. Now, to be fair, I don't take that completely seriously. The fact that the US GDP and basically all of BRICS combined are roughly the same amount, I just don't take that super seriously. But start defaulting on your debt payments to other countries and watch the US dollar lose its reserve currency status instantly. That would be an overnight problem. So, what does that leave us with? Well, we talked about the first three. Those are probably pretty tough to implement. Option number four is we print more money. We produce the melt up, the great melt up. So, what does this look like? First off, let's set the tone. Higher money supply, more dollars, more printing. That's inflation, period. That's inflationary. That said, this is really the only viable solution, and it's also the most likely outcome. The cost of everything goes up in this scenario. Goods and services, income, that's kind of nice, right? Also assets, stocks, bonds, real estate, lots of opportunities in that field, but so does the cost of living. The amount that people pay just to live in their day-to-day lives goes up dramatically. Here's a note. Here's a note, especially when we talk about printing money for government uh, systems, government services. In inflationary times, it's the wealthy that benefit because the wealthy hold more assets, right? They own more businesses, they own more real estate, they own more assets overall. In inflationary environments, assets overall typically benefit, I mean, at least in tow with inflation, oftentimes much more than inflation, right? Much more than the rate of inflation. So if we want to print money for services, for government services, for maybe, the middle class, the lower class, the lower income, we're talking really at the end of the day, the money circles back to the wealthier because they hold more assets. We'll talk more about assets during this period in a minute here. So the reality is, with the other options unlikely to happen and us running out of options, printing money is the last, it's the least terrible solution that we have, right? And what that leads to is the snowball continuing to grow. And as we noted, potentially the middle class shrinking, which is this discussion here. Oh, I love this. So, guys, take a moment here for the poll. If you pull up the poll, if you see the poll pop up here, we just went through the best four options. They're all bad. They're all tough. They're very difficult decisions. Which of the options that we just pulled up in the poll do you think is the best option, the best solution for the government to move forward on to solve this crisis? I'm going to give you guys a second to do that. Just had to adjust one thing. Yep. Some good answers. Some good answers. And then let's see. Team, can they see the poll? Can they see the poll responses?
Let's
Okay,
see. I'm sharing the results right now. Can you see it?
amazing. Okay.
We're
So,
50-50 really with cut spending and printing a lot more money.
yep. Yep. So I mean, that's good. Means we have a smart audience. We know that defaulting on debt is probably a pretty brutal option. We understand that increasing taxes we probably need to do a little bit and rebalance our income a little, but there's an upper limit there. So we're going to bump into that to some degree. So these are where my head goes to. One is we just need to spend less, although it's extremely brutal. The likelihood of getting it done is tough, but good answers, guys. Thanks for jumping in there. Okay. So let's talk about the middle class. How does this affect the middle class, right? We know that a huge amount of the country is small business. We know that middle class is disproportionately involved in small business and supported by small business. How does this affect the country as a whole, and particularly the middle class? Real wages will increase over inflationary environments. The question is not will wages go up, which is highly likely. The question is do wages increase more than the cost of living? Or does the cost of living increase more than wages? That is the squeeze on the middle class. What we are seeing in this inflationary environment, in this inflationary pressures that we're looking at, is that cost of living is increasing more than wages. That's the problem. That's where when we saw certain politicians say, no, 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 the economy's amazing, and people are like, I'm not feeling that. It's because of that single metric. How much more are you making? And then how much more is it costing you just to live? So that's the biggest nail in the coffin for the middle class if that trend keeps occurring. The problem is we started this in this country. There's a big fight over the evil, greedy corporations, right? The problem is corporate net margins have been steady overall, right? Some have gone off the charts. Sure, let's blame those evil, greedy corporations. But as a whole, most corporate net margins seem to have been steady over this period of time, while their costs also increase. So more or less, these big evil greedy corporations, quote unquote, are passing along their cost increases directly to consumers, which that is the real problem, right? Is that costs are increasing so much. Savings is near record lows. Increased reliance on credit card and different credit methods is going through the roof. It's a scary part that we should do a different webinar on this because there's a lot here. So high rates, they're really a double-edged sword. Fed rate hikes are, in place in order to combat inflation, to slow down the cost of living increases, right? But they cost economic growth. So they actually slow down revenues for the government in many different ways. That can fuel debt as well. It also increases the cost that the government pays on their own debt expense, like we said. The result is rising defaults on corporate and personal debt that we see. It's not out of control, but it is increasing and it's not a trend that's going down. Also, we don't have to over drill down on this, but this increases the wealth gap. So you hear politicians, hey, the wealth gap, or out of control rents, etc. A big part of this is mismanaging the books of the country. Again, I'm an economic voter. I think a lot of these are solved by just managing the books more appropriately for the entire country. All right, let's talk about you. We talked about the overview, but most importantly, let's talk about you and what you can be doing and what you could, implement with this information. First things first is what do you freaking do with all this? How do you protect your wealth in the midst of governments making tough decisions that impact all of us? The first is consider diversification. We hear that all the time, right? But what does that actually mean? In this case, it means checking out multiple asset classes that you feel comfortable with, that you understand the investment thesis, the investment strategy of, and spreading the risk around for those key asset classes. This is understanding the importance of hard assets in inflationary times, right? We're talking real things that you can touch. Some people might be into gold, Gold's not really my thing. I'm a real estate guy. I'm always going to go to real estate. I like the four walls. I like the roof. I like knowing that that's a real tangible thing. So if inflation goes through the roof, so does that asset most of the time. And then the last is mitigating risk in your portfolio. All these changes, what do you do about them to hedge your risk, to block a lot of the risk that's in the market today? So, understanding why an investment is likely to be successful or not likely to be successful, rather than just buying into hype of an individual or any particular group that's been saying the same thing for a long period of time. You need to understand this market environment that we're in today. So, stock market mania, or are we in a meltdown? Well, if you look at the stock market today, you might be having the meltdown discussion, but I mean, again, S&P 500 down 3%. It looked like a sea of red. It was not a beautiful day in the market. But overall, rising equity valuations are to be expected in the midst of this, right? Like inflationary periods, equities should go up, but there's a lot of warnings and concern around that. Here's something that most people don't talk about. We just talked about diversification. The stock market historically was a great tool to use for diversification. Since 1995, however, the number of companies in the stock market has been reduced by over 40%. So if you look at the top stocks, you look at Magnificent Seven or any, upward grouping of the top most valuable companies, it's way disproportionate how much value the top companies hold in the S&P or any other index. So diversification, I mean, we're really only talking about a handful of companies a lot of time that are the real market movers. Less companies want to be public today. More are going private. That means less investment opportunities for you as the investor. So in a time where inflation's rising and cash might be a big problem, this is the time to be checking out investment opportunities in the private sector potentially for bigger opportunities and more diversification. So here are some assets that are real assets, things that really exist, things that are tangible that you can touch and that you can consider. We're going to start with real estate. So what happens in this environment in an inflationary melt-up period? Well, what we're talking about here is not 2008. 2008 was a bubble. It popped. There's a crash. What we're talking about here is basically the opposite of 2008. It's where the pressures upward are not just the problems of 2008, maybe over speculation, maybe over lending, et cetera. We're talking about systemic upward spirals of debt, right? So the holes in the bucket from 2008 largely have been plugged, if you want to think about it that way. We as a country have gotten really good at protecting against straight up crashes. We have not, as a country, figured out the exact solutions to upward spirals in the bad direction for the wrong reasons. Okay. So it won't look like 2008. Instead, we're going to need to solve today's problems, not yesterday's. So some lessons from financial history, what we've learned in similar situations of uncharted territory financially. Here are some mistakes that common investors, or that here are some common, excuse me, here are some common mistakes that investors have made in similar times. One, in inflationary environments, holding on to cash is bad news. We know that. If you held on to cash in 2022, remember, Janet Yellen, right, the Federal Reserve previous chair, is telling you inflation is transitory. If you listened and you took that at face value in 2022, you lost 9.1% of the value of your cash in 1 year alone. Okay. That means the next year you have to make 9.1% just to break even, plus whatever inflation is that year, plus if you want to make a few bucks. So losses due to inflation are brutal. We highly recommend you stay out of cash to avoid those types of just avoidable losses. But it puts investors in a tough place because you as the investor, anyone as the investor in this market is now stuck. You can't just sit, because if you sit in cash, you're losing money to inflation. But if you make the wrong investment, you're losing money to that investment. So the best middle ground right? Rather than getting stuck between a rock and a hard place, is to find the right, stabilized, consistent assets that benefit from the period. So the best practices to find these assets, to find opportunities, keep it simple. The market environment we're in is too complex to be doing things that are, too risky, too complex for implementing the business plan. You have to understand the thesis. You have to understand how your investment makes money and why. Look to the Fed, look to Congress, look to economic numbers. Let's see what is going on and what's being indicated, right? We can learn a lot just by seeing the obvious things that are put in front by the people making the decisions. And then consider the opportunities. All that said, once you have a lay of the land, once you understand your investment options, how do you benefit from that? Inflation, we talked about that. That's obvious. What about when, the president-elect is talking about growing the manufacturing sector dramatically, right? How can you make money from that period of time? How can you make money from a period where different markets are pretty rock solid with, low inventory, et cetera? Those are opportunities to consider in an environment like this. So, action steps here we talked through. We'll just kind of do a recap. Diversify, right? My personal favorite diversification strategy is blending two pieces, two different strategies. I like the barbell approach kind of style. One is fixed income. Fixed income. It's knowing exactly what you're going to get month after month. I personally like checks every month. I don't like the quarterly distributions on a fixed income play, but to each their own. So fixed income, where you know your returns, you know what that looks like. The other is growth, right? It's what appreciates over time. What benefits from the market conditions and the value of that asset goes up over time. With both of those in a barbell approach, you wake up in a situation where I believe it's the best balance for diversification that you can find. Now, if you wanted inside baseball and you wanted me to tell you exactly what my eyes are on, what our team's eyes are on for both of those categories, for fixed income, I actually truly 100% believe that for the next decade plus, the best opportunity for fixed income is single family mortgages. That market is so impacted. You have something like 20% of mortgages in that market are government backed. You have something like 40+% of mortgages in that market that are at interest rates that are irreplaceable. They can't afford to move. They'll never get that rate again. So they're locked in, which reduces the amount of supply. I mean, it's such an impact. It's such a tight market that people want to stay in their houses. It's rock solid after 2008, after all the changes they make. I love single family mortgages for the fixed income component. Now, for growth, we talked about the other. I love real estate still. I'm a real estate guy. I always probably will be. I'm really bullish on real estate. So the question is, where in real estate has the best opportunity, right? Because if you look at some of the numbers, you might look at the office numbers and it's a little scary. I don't recommend office. The number one opportunity that I'm seeing, that we're seeing as a team in the market for growth, is industrial. The industrial real estate market is incredibly opportunistic right now. You got not even Biden, you have the CHIPS Act, you have all these huge pushes that even the Biden administration was pushing to bring manufacturing, to bring industry back to the US. And then you have Trump, who's actively saying he wants to bring all this stuff home and creating tariffs, creating barriers around the US that make importing goods more expensive. So that's an unfair advantage for US suppliers, for US manufacturers, for US distribution. So I think historically multifamily, I still think great things over the long term for multifamily, but I think multifamily benefited from being a privileged asset class. And I think industrial is the next privileged asset class for 10 to 20 years ahead. So something worth checking out. Either way, what you're looking for is an all-weather scenario, an all-weather portfolio, something that balances the scales. One hedges the bet of the other. So I like fixed income and I like growth. I like those real estate backed in inflationary times. But what you need to look for yourself is an all-weather portfolio you feel comfortable with. We think that alternative assets and real estate particularly have that. And it's to be ahead of the tactical shifts in the market that you can tactically address the changes and benefit from those. There's a lot of data. I mean, shoot, we have a economic tracker at Saint. If you want to check out what's going on, we cover everything from CPI to PPI to market expectations in different market segments. Check out the website. It's on the site. You can download a link to that and check out. We update it monthly. So if you're looking for something like a fixed income fund, let me just tell you that there are a few things to consider on that side. First, there are two things that a fixed income fund will benefit from in this environment, right? The two biggest questions we have are what happens to fixed income or mortgages in a rate environment that's going to change, right? So if it's the it does so the bigger question is what's the impact if rates go up and what's the bigger impact if rates go down? Well, what we can see is over a 10, 20, 30-year period, we see trends. Mortgages in the United States have track records, so it's something that we can look to. So, like I said before, we think the number one opportunity in the fixed income space is going to be single family mortgages. So let's dive in a little bit and we'll talk about why we see that as the best fixed income opportunity. So if rates go up, if rates increase, well, mortgages are fixed. The vast majority of mortgages, right? What is it? 90 something percent of mortgages are fixed in the US. So if rates go up, that just means that the mortgage that you already invested in at a fixed income rate, a fixed interest rate, I mean, those mortgages are more stable because if you invest at X and then the rates go up beyond X, then that individual in that house is very unlikely to want to go refinance and get a higher rate. There's very little advantage to that. Also, if there's less refinances in your portfolio and your mortgages are stable with a fixed interest rate, then your cash flow is more stabilized over the longer period of time. So less portfolio turnover equals more stability and more income. And again, we get to see your income for 10, 20, 30 years in the future. So what if rates go down, right? We're in a slightly decreasing rate environment. So this is probably more pertinent to today's situation. Well, if rates go down, a few positive things happen. One, it stimulates buying in the market. So the underlying assets of the mortgage that you're invested in, the underlying asset being the house, actually goes up in value. So it's less likely that individual is going to default. You're less likely to be in a foreclosure situation because their equity in their home is increasing. It also stimulates investing into the marketplace, further driving up the asset value prices. And it does stimulate refinances. We're very comfortable with that in a lowering rate environment and when rates are going down. Because what that does is, if you look at an amortization chart, and this is a lot of inside baseball, but if you look at an amortization chart, which breaks down principal versus interest of every payment for all 30 years of a mortgage, you know that interest is front loaded. So if somebody refinances after, I don't know, 7 years, the vast majority of their payment went to their interest, right? So if you look at the returns net to, like the Saint Income Fund, it actually boosts returns when people refinance. All we do on our side is get that money back in and buy more mortgages to bolster up the portfolio even more. So if rates go down, that's great. It's actually a very safe environment, and we just add more mortgages to the portfolio. So if this is something you're interested in, if you want to learn more about the Saint Income Fund, which pays all the way up to 14.28% returns annually, then I would take a picture of this QR code or text wealth to 949-787-097 or 0957. Also, Ange, thank you. We just dropped a link to the calendar for Luke. Luke is our investor success professional. He's our director of investor success. He will get on the phone with you and provide do a whole walkthrough of what you're looking at, what you're trying to solve for, as well as a tailored to your situation investment strategy of what you could look at and how this might work for you or what steps you could take in the right direction. So these are personalized investment strategy calls directly with Luke. He's on these all week helping people, and he's great. I love talking with Luke. So highly encouraged check it out. If you have any questions, you're welcome to ask these in Q&A also.